Are the rules on inherited IRAs changing once again? We'll give you the latest out of the IRS on some proposed changes that they're going to make that will continue to impact how beneficiaries inherit IRAs. Plus, it's tax season, right? 30 days plus or minus to go. So that means that you're probably in the midst of trying to figure out your tax return. Well, we thought it would be important on this program to maybe talk about the top 10 red flags and, more importantly, how you avoid them. Because after all, certainly don't want to engage in a conversation with the IRS these days, because that's going to be a one-sided conversation because they're not even answering their phones with that organization these days. So we will cover all of that. Welcome, of course, to the program. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio programming, coming to you on a variety of stations throughout the Central Florida region. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week when we're not doing tax return preparation work for our clients to help you change your life with a successful and cost-effective financial plan. So, of course, before we get to all of that, we've got a busy week ahead, not just in the midst of tax season at the office, but we've got our regular quarterly client educational dinner coming up on this Thursday. Those events are reserved for clients and guests of clients who have an opportunity to come and listen to a portfolio manager and hear about the latest and greatest. So relatively timely that we've got that on tap in terms of office events and educational opportunities for our clients, because certainly a lot to talk about. Speaking of a lot to talk about, as you know, over the past few years, well, this started actually a few years ago, we sat down and wrote a booklet or a pamphlet that's now sort of a booklet. Maybe now it's graduated to a book because we keep adding chapters to it. It's called The State of Your Retirement, what every state of Florida employee needs to know about their options between the investment plan, between the pension plan, between drop, and we've added in some new chapters on our latest 4th edition, which we just sort of finished up this past week as well. So all of that is the latest and greatest from sort of the home front at the office side of things. Of course, we need to talk about the home front in terms of your investments and the headlines, as we like to do in this initial segment of Dollars and Cents. So if you're keeping track, last week was a volatile week. And remember, we like to use the word volatile in line with its actual dictionary description, because volatility doesn't just mean negative, it can also mean positive. The very definition of volatility is its up and down movement. So we talk about volatility in the market, well, you can also have up periods of time as well. And certainly last week, and if you're looking for easy explanations, there really probably isn't, because last week certainly had its share of negative headlines, right? We now have the headwinds of the Fed raising interest rates. They raised them a quarter of a point. That certainly is going to have some implications, right? That's going to have some implications on your borrowing costs. We saw the yield on 10-year treasuries go above 2% all the way up to 2.15% this past week. So that's got implications on if you're borrowing money to purchase a home. If you unfortunately have credit card debt, which you really shouldn't, you need to focus on that and get rid of it. But that cost of that debt and pretty much all kinds of debt which are based upon sort of those prevailing interest rates saw a little bit of an uptick as a result of the Federal Reserve's move. Why did they do that? Well, that's our good friend inflation that has appeared on the horizon after an approximately 10, 15-year absence. He's back, and He is a force to be reckoned with. And the real question is whether the Federal Reserve is behind the 8 ball on combating inflation. Certainly, if you walk into a grocery store or go to a gas station, you may think that they are running a little bit behind in terms of their combating that. Remember, the Federal Reserve responsible for creating that perfect temperature porridge for the economy. Not too hot, not too cold. They use interest rates and things like that to help make sure that the temperature is just right for the economic porridge. The problem is, with inflation running as high as it is, and then you've got the backdrop of all of the other headlines, Russia, Ukraine, all of that, then you wind up having a little bit of a difficulty trying to raise rates while at the same time trying to combat inflation, trying to give yourself enough room should there be an economic pause or an economic downturn as a result of any of those events. Oh, and then, toss in the latest headlines about COVID and stuff like that. So the Federal Reserve obviously in a tight spot. The real question is whether they've perhaps waited a little bit too long. But anyway, against that backdrop, the markets had one of their strongest weeks in quite some time. Overall, markets, and again, I guess this is based upon the hope of some kind of a ceasefire. Oil dipped back below $100 a barrel, so there was a little bit of optimism in the market. For the week that was, the Dow was up about 5.5%. The S&P 500, which is the broader market index that we kind of like to eyeball in terms of relative performance, about 6%. NASDAQ, all those large tech companies actually had the strongest rebound. It's also had the strongest decline since the beginning of the year, up about 8%. So that's the week that was through market close on Friday. Certainly an eventful week this past week. I'm sure it will be another eventful one this coming week. But an interesting week that sort of underscores what volatility is and the reason why it is so hard to really try and predict which way to go, which way to turn. So that's why when we talk about the best course for your investments over time is to remain consistent, weeks like this past week really sort of help to underscore that concept. Hard to do. Sounds easy, right? Sounds easy in practice. Hard to do for a lot of folks in reality. So those are the latest numbers. Speaking of kind of the period of time that we're in, obviously tax season, and you all know about the chaos that is the IRS. We've certainly talked about that at length on the program. Something like only 1 in 10 calls are getting answered to the IRS. They're about 24 million returns behind. If you're keeping track, I still don't have my refund from last year. Antiquated technology, not really able to pivot to online like the rest of the world. And then, of course, throw in the tax code, right? The Byzantine tax code that we have that is getting more and more complicated each and every year. Throw in some stimulus checks, some child tax credits. You get all of that. So in other words, when we return here on Dollars and Cents, we're going to talk about ways that you can just kind of avoid interacting with them, right? Isn't that the better choice? So coming up next, some of the red flags that you need to know about when preparing your tax return and how to avoid them here on Dollars and Cents. It's tax season, and we're talking about some of the ways you can sort of avoid interacting with the IRS, right? Because who wants to interact with an agency that only is answering 1 out of 10 calls? Like, how could you possibly navigate a conversation, a discussion about your tax return if the IRS has questions? Because they ain't even picking up the phone. So you probably want to just avoid that interaction altogether. So we've got some things on the program where we talk about some of the most prevalent sort of red flags, if you will, and how, most importantly, to avoid them. And I guess it really does start with making sure that you are doing your return as accurately and as thoroughly as you can be. Because particularly now, with the stimulus checks, the child tax credits, a lot of people got money, and sometimes people forget that they got it. You would be surprised. I have numerous examples in terms of tax returns that we're doing at the office where not just one person, but like 3 people have asked folks that says, are you sure you didn't get your stimulus? Are you sure you didn't? Are you sure? And then, and then finally it's, oh, well, let me go check. Well, you should have checked at the beginning. That's part of preparing an accurate tax return. So it's important that on these stimulus checks and these child tax credits, where you got money ahead of time, or you got money last year, that you need to accurately know those numbers in order to be able to report it correctly on your tax return. So it starts with that, right? I mean, that's kind of fundamental, but there are also some more specific things to kind of be thinking about when it comes to your taxes, and some of the things that could in fact trigger some kind of a red flag. So these aren't in necessarily any particular order, if you will, but there's certainly things that bear discussion here on the program. We are, of course, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, including those decisions that you have to make when you're putting together your tax return. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team stands ready to help you change your life this week with a successful and cost-effective financial plan. So, number 1 on the list is educational tax credits. Now, there's really a sort of a couple here that you need to be aware of. There's the American Opportunity Tax Credit, and then there's the Lifetime Learning Credit. Both come with different eligibility requirements, and the American Opportunity Credit only allows you to claim to use tuition, books, but not room and board if you're going to use the American Opportunity Credit. The other thing about the American Opportunity Credit is it's only available for a particular individual for 4 years. It's meant to be a tax credit that goes to those 4 years of undergraduate study. So here's where the confusion comes into play, right? You got 2 different credits, each one a little different from the other, and it's easy to claim the wrong one in a particular situation. Maybe you've already claimed the American Opportunity Credit for 4 years, you proceed to claim it a 5th year. Oops, that's a problem. Number 2 is you can't claim both credits at the same time, and particularly you can't use the same expenses as you would for each credit, right? You don't get to double dip those expenses, and you don't get to double dip those credits. So watch your information that you're putting on your return. If you're trying to claim these educational credits, they're very, very valuable. You certainly want to be able to utilize them on your tax return, but be careful. There's definitely some nuances between the 2 main credits in terms of eligibility, in terms of what year the kid is in school, and what types of the college expenses are you using. So make sure that you sort of look at that one and say, okay, got to figure this out, got to take a moment, make sure I am clear on that. Number 2, and this comes without saying, if you're running a small business, right? If you're running a small business, an S corporation, a sole proprietorship, or maybe even a partnership, particularly if that business happens to be cash intensive, those are the kinds of things that you may see significant underreporting of income or excessive deductions. Again, the IRS knows this, particularly on cash-oriented businesses like restaurants, bars, grocery stores, things like that. That the IRS specifically is kind of teed up or focusing or looking specifically at that. Make sure that you are properly reporting that income and also the expenses. And I think the other thing about S Corp that you need to realize is that one of the reasons why you use an S corporation is to try and avoid the FICA tax, which as a self-employed person is like 15.3%. So, I get that you want to avoid it. Well, so too does the IRS. And so you can't overutilize that S Corp structure to give yourself a wage, a W-2, that is so significantly less than really what would be reasonable for you if you are working a normal job. I'll give you an example. So let's say I got an S Corp and I got $150,000 profit, but I only paid myself a $10,000 W-2, but yet I spent 50 hours a week doing the work inside that business. The IRS is really going to look at that one and say, yeah, you're probably with that. So just know that if you're using some of these small business types of structures, that it's important to do that. Those are opportunities that are afforded to you under the tax code, but know that you've got to also understand what's reasonable and what is not, particularly if you're using S Corps to avoid the FICA tax. That's an area that the IRS looks at. Also, to further complicate things over the past couple of years, a lot of payroll protection plan money has been distributed out to a variety of small businesses. Maybe that's tax-free. Maybe it's not. Depends on how you used it. So understand that there could be some wrinkles there as well, which are relatively new because of COVID and some of the money that got paid out, particularly under the PPP types of programs. So make sure you're really paying attention if you avoid things like excessive travel and entertainment expenses, avoid mixing business and personal income and expenses, things like that. Those are the things to be aware of as a small business owner. Next up, the child tax credit. And this one, again, is one of the ones that's got a new wrinkle for because last year they advanced some of that child tax credit. And here's the thing, we've talked about this at length on the program, particularly when we have one of our associates, Kristen Cayley or Christina Lamb, on the program, the folks that are in our tax department at Nelson Financial Planning, talk a lot about this one. Is look, with the child tax credit, you've got to true that up. If you got it, well, good, but just because you got it doesn't mean you get to keep it. That's in direct contrast to the stimulus checks. Stimulus checks, if you got them, then great. You can go invest in some meme stocks like we were talking about on the program last week, but you don't have to worry about giving that back. With a child tax credit, that's different. So the child tax credits changed, obviously increased pretty dramatically, went from $2,000 for children under the age of 6 up to $3,600, and then for children ages 6 to 17 went from $2,000 up to $3,000. So pretty significant. And then what the IRS did is they gave you like half of that in monthly checks between July and December of last year. So what that means though is that you got some money and you're eligible to further get some additional credit for that same thing on your tax return, but you've got to make sure that you reconcile and figure out exactly what those numbers are. So be aware of that child tax credit. That one, quite complicated. Look for the letter 6419 that would have come out to you that describes the exact amount of the amount that you got on your stimulus check. For a married couple, each one of you would have gotten basically the same letter. So just be aware of that and how that letter winds up playing out. Next up, crypto transactions. We'll talk about those and how to avoid the red flags on that on your tax return. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we're talking about some of the red flags that can catch the IRS's attention and, more importantly, how you can avoid them. I think we're up to number 4 before the break, and number 4 involves crypto transactions. How important is this one of an issue for the IRS? Well, happens to be the number 1 question on your tax return. Did you buy, sell, exchange, receive, or otherwise touch any matter, I mean, I'm paraphrasing, in any cryptocurrency? That's the number 1 question on this year's tax return. Why? Because the IRS has been taxed or mandated to collect $30 billion in crypto tax revenue over the next 10 years. They see this as an opportunity to collect tax revenue. Problem is that crypto transactions can be not necessarily complicated, but hard to track. A lot of
financial institutions when you're thinking about tracking, and particularly from a tax perspective, right? Because for a cryptocurrency transaction, you would need to know your basis, what money you had in, and then ultimately what you sold it for. That difference, that gain, if you will, is what the IRS receives tax revenue on. So if it's an asset like a stock or a mutual fund or something like that to a financial institution, well, then all of that gets generated as part of your tax documents on your 1099-B. Typically today, firms are required to provide you with the cost basis, and in a lot of cases will actually be reporting that information to the IRS. Well, as you might well imagine, crypto doesn't work that way. And so
a lot of folks use, multiple exchanges around the world, multiple different digital wallets. And if you're doing that, then it requires you to kind of go through and keep pretty good records and really be able to sort of track the transaction. So that's the complicated part of it. There's actually a special form 8949, that you have to use to aggregate all of that, which is why a lot of just kind of general tax people will say, hey, you got to go see, kind of a tax specialist in the crypto side of things, because of
that difficulty of accurately tracking all of that basis, what you put in, what you sold it for, particularly across multiple cryptos and multiple digital wallets. So that one in particular is one that is a little bit more complicated and certainly has the attention of the IRS. So they're paying attention particularly on that. Next up is the Earned Income Tax Credit. About 25 million Americans are eligible for that. That did expand a little bit in terms of the eligibility for folks to get that Earned Income Tax Credit, but sometimes those credits can be calculated in error, and certainly claiming children that aren't really your qualifying children in order to boost that Earned Income Credit, that will certainly create a red flag. If you have any investment income, particularly if you're earning more than $10,000 of investment income, whether that be dividends or investments or rental or capital gains, then that makes you ineligible for the Earned Income Tax Credit. So be aware of the limitations associated with that one as well. Similarly, large charitable contributions, right? Your kids don't count as a charity. I love that question. I get that question a lot. Well, I gave money to my kids. Can I write that off? No, you can't, unless your kid happens to be a 501c3 corporation, which I doubt they are. The reality is that you have to really be careful about those charitable contributions and how you are reporting them, particularly if you don't keep receipts. If you're using inflated values for non-cash donations. One of the suggestions that we always make when you're giving, trying to write off a large amount of non-cash donations, right? Think about those trips to Goodwill, Salvation Army, things like that. Just take some pictures to really kind of have the evidence in the background so that you can show, hey, here's what it was, and it really was in mint condition, still in the box, if you will, in order to judge
that big of a deduction. So charitable deductions, obviously another area of interest for the IRS. And then so too is rental income, particularly on mixed use properties. And those are properties that maybe you've got a property that you put on VRBO or Airbnb, but then you went ahead and used it
for spring break, right? So
and that you now have sort of a mixed use property where you're getting some personal use out of it, yet it is being rented. So just be aware of those rules involving mixed use property. And the reality is that with rental losses, you don't get to use those against your W-2 if you're above a certain income limit. So just be aware that that rental income is passive income that creates passive income or passive loss. So that's another area where folks really have to kind of keep good records, keep track of that, particularly if it's one of those mixed-use properties where you're using it for spring break, but then the other times it's getting rented. Make sure that you're keeping a
calendar log of who's there and when. That would be the important thing to sort of keep track of along the way, because certainly those would be that would be a potential red flag with the IRS as well. Similarly, our home office deductions, and this one's kind of tricky, particularly in the land of COVID, because what you used to be able to write off as a W-2 regular employee got eliminated with the tax changes that happened in 2017. So prior to that, you were able to, as an employee, write off, if you were itemizing your expenses, write off unreimbursed employee expenses. So, and certainly, that was things like, I had to buy a printer, or I needed to upgrade my internet at home, things like that. Yeah, you could write those off if your employer wasn't reimbursing you. But those got eliminated. So all these folks over the past couple of years have been working from home, still maintaining their W-2 regular employee status. You can't actually write any of that stuff off. So that notion of the home office deduction kind of got squashed, particularly as a result of COVID and a lot more folks kind of being in that position where they would say, well, wait a minute, I had to work from home and all those kinds of things. The reality is that you don't get that home office deduction like you would. Now, if you're self-employed, then that is certainly where you could use it, but just understand that there's some exclusivity to that room, right? It's not like it's the laptop that you're using on the kitchen table and then you're writing your kitchen off as a home office. No, it has to be sort of an exclusive area that's prepared to work in and things like that. So just be aware of the difficulty with home office deductions, particularly these days as a result of COVID and a lot of the rule changes that happened in 2017. Similarly, early withdrawals from IRAs or 401ks, right? If you're under 59 and a half, there's some rules you have to observe. Also penalties if you are not age eligible, if you don't have one of the exemptions available to you to be able to draw money out and avoid the 10% penalty. Maybe that's for disability, maybe that's for educational purposes, first time home, maybe you retired over 55. Those types of things are exceptions to that 10% penalty. But, and here's the big but, you really need to make sure that those transactions have been coded properly on your 1099, and best to file Form 5498 where you're reporting the exact code of those distributions so that you can say, okay, well, these are not subject to the 10% penalty that would typically apply. And then lastly, of course, is the health premium tax credit. That tax credit is available as a reduction of your health insurance premium if you are getting that through the exchange, or otherwise known as Obamacare. Now, the problem is, just like the child tax credit, that requires you to true up whatever the credit was that you got towards those premiums on your tax return. Remember, the premium tax credit that you got for your health insurance policy is in advance. It's not a real credit unless it flies on your tax return. So that's one of the areas where also red flags, you put that on the return, you still got to true that up. And that could mean that you wind up having to pay a chunk of that advanced tax credit back, or you may actually be eligible for more. So certainly that's an area where things can get kind of confusing on the tax return. So that's it. Those are the top 10 lists of IRS red flags, and more importantly, how you avoid them. When we return, we'll talk about some of the proposed changes to inherited IRAs coming up next year on Dollars and Cents with Joel Garris. Welcome back. We're going to talk on this segment about the latest proposed changes to your retirement, specifically your IRAs, 401ks, 403bs, all of that, and how it relates to your beneficiaries, because the rules are changing potentially yet again on those. As many of you know, the Secure Act that passed in 2019, we have referred to on this program as the single largest tax increase on your retirement ever. Why? Because when you pass away, your beneficiaries used to have the rest of their lifetime that they could take that money out. So imagine that, right? Pass away at 70, 80, wherever the case may be. Folks in their 40s and 50s inherit, or maybe you even left it to some grandkids. That is decades of continued tax-deferred growth with only a required minimum distribution to be met. Well, all of that disappeared in 2019. Now, anybody who inherits a retirement account, and there are exceptions, which we'll go over, those folks have a 10-year window in which to take that money out. Now, there were some gaps in kind of how the Secure Act talked about this 10-year rule as it relates to inherited retirement accounts. And so what the IRS did last month is they put forth a proposed rule that would sort of help to fill in those gaps. So we want to talk about what was in the meat of those proposals, so you can start to kind of make some plans for the road ahead, particularly as it relates to retirement accounts. So welcome to the program. This course is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So if you're not able to listen to us here fully on Sunday morning, then you can always go to your favorite podcast channel of choice and just search for the program, Dollars and Cents with Joel Garris of Nelson Financial Planning, and you will find our channel. If you have problems, go to our website, nelsonfinancialplanning.com, upper right-hand corner, bunch of icons. Click on the one that looks most familiar to you, and then there you go. You'll be instantaneously connected to our channels on whatever your favorite platform of choice is, whether it's Spotify. If you want to see the video of the program, that's on YouTube. If it's Facebook, Amazon Music, all of that, we are there. So check us out there. Best way to know when we upload new stuff, subscribe to the channel. That's always a good option as well. So anyway, back to some of these proposed changes that are floating around the IRS. The intent here is to sort of fill the gap, if you will, on what the Secure Act did in terms of changing the rules on inherited retirement accounts. Before that, obviously, you had the stretch rule that allowed you to take that money out over the course of the rest of your life. Now that rule is gone. So what that means is then more of the tax revenue associated with retirement accounts is going to be collected in a shorter period of time. So look, folks in Washington, they're desperate in need of money to help finance some of the stuff that they're doing up there. And so consequently, this became a natural place to go because the world has changed over the past 20 or 30 years, and folks don't get pension checks anymore. For the most part, it is based upon you funding your own retirement. Well, what that means is that that money is just beginning to sort of pass to the next generation, right? And so consequently, the amount of dollars has increased dramatically. If you look at the numbers in 1995, so it wasn't that long ago, 25 odd years ago, the reality is that you are looking at about $3 trillion in retirement accounts at that point. Today, it's $22 trillion. So a 7x, over 7x increase in retirement accounts. So what that means then is that that's a great place to tap untapped revenue, if you will, which the folks in Washington love that. So hence they changed the rules on it. So New Deal course, 10 years. General assumption that it will take that and this is where these proposed rules comes into play. The general assumption was that as long as you took it by year 10, then you were fine. Well, that option of that flexibility of, I don't have to take it this year, I'll wait, I'll take it in later years, but as long as I take it out by year 10, that, based upon the proposed regulations, that option or that flexibility is something that the IRS wants to take off the table. Keep in mind that the 10-year rule does not apply to spouses, does not apply to disabled beneficiaries or folks that are within, or beneficiaries that are within 10 years of age of the decedent. It also doesn't apply to minor children, but it does kick in once they turn the age of majority in the eyes of the IRS, which is age 21. Okay, so the real confusion was whether you had the full 10 years of flexibility. If you were not in those categories that we just mentioned, kid or spouse or disabled or within 10 years, you had that traditional 10-year rule. There was enough lack of clarity in the Secure Act to suggest that, okay, well, I don't have to take out a little bit each and every year. I can sort of pick and choose when I get to take it out, so long as it's out within that 10-year period of time. Well, in these proposed regulations, the IRS is saying, no, you don't necessarily get to do that in all circumstances. So what the new rules suggest is that they're going to look at, again, the original account owner. And had they started, or were they age required to start required minimum distributions, or were they not? And so you have to look at when they died and compare that to April 1 of the year after they turn age 72. So that's the latest in which you had to take a required minimum distribution. So if the account owner died before that, then you don't have to take annual payments. You actually have that full flexibility to take it out, hit or miss, over the course of that 10-year period of time. If, on the other hand, the individual had started to take required minimum distributions, then the IRS is going to force you to sort of continue that required minimum distribution type of mindset, where you've got to take out money each and every year over the course of the next 10 years, ultimately spending out that account over that 10-year period of time. So basically, it's going to revolve around, when you inherit a retirement account, how old was the owner? Had he started to take required minimum distributions? Was he before required minimum distributions, or was he after? And then that's going to determine whether you've got to observe sort of the equal installment approach during the course of the next 10 years. So again, if they're after the required minimum distribution age, April 1 of the year after you turn age 72 is sort of the dividing line on that. If they were, then you're going to have to take out some equal installments when you inherit the retirement account. If they weren't, at least based upon these proposed regulations, then you've got the full flexibility to kind of take it out, hit or miss, but must get it all out within that 10-year period of time. So a little less flexibility for beneficiaries as a result of kind of these proposed changes. We'll let you know if they actually go from proposed to real rules. We suspect that they might, which is why we wanted to kind of get it out there for our listening audience. But obviously, we'll keep you posted on that. In the meantime, we're going to wrap it on up and get on out of here. Thank you all for listening to this week's edition of Dollars and Cents. This has been Joel Garris of Nelson Financial Planning.